Hi, folks. Brett Girard here, Portfolio Manager at Liberty, coming to you with another Liberty Market Update. This is for the month of November 2020. It's been a couple months since we've done one of these. We've been working on figuring out the right technology to use the videos and share with you, but we think we've landed on one now. It's called Vidyard, some technology out of Kitchener. So always nice to be using some Canadian content. Let's get started. So first, we'll just get into a quick disclaimer. We want to make sure that we keep the lawyers happy, and you're more than welcome to read this, but the high level here is this is for informational purposes only. This is not investment advice, and if you do have any questions, please consult a qualified professional. Myself and the rest of the portfolio managers at Liberty would be happy to answer any questions that you do have. So 2020 in a nutshell. This is from January 1st through to November 30th. And it's quite the year. We can see the purple line's the NASDAQ, so that's out in front in the lead with about a 40% return year to date. Next is the S&P 500, that blue line, up about 12. The TSX is the orange line there, and it's actually positive for the year, which is great. Below that, you can see the Dow Jones, which is sort of that darker orange. And then struggling to make a positive return for 2020 is the Euro Stoxx 600, still down about 5% for the year. If we go into the next slide, what you can see is specifically the performance over the last month. So you recall, it feels like a million years ago, but it was just the beginning of this month that, or I guess the beginning of last month now that it's December the 1st, the beginning of November when the election happened. And there's still some items to be sorted out, but it looks like Joe Biden, who the president-elect right now, will be the president in the Oval Office as of January. So the markets reacted positively to that. And then also we had sort of the trifecta of vaccine information. So first it was Pfizer, then it was Moderna, and then AstraZeneca, all reported about 95% efficacies with their vaccine. So those have sort of been the wind in the sails of the market. And here what you can see is actually the opposite of the year-to-date returns. The European numbers, the green index there, that's actually done the best. And this is something that, it's hard to do in the short term, but we really want our clients and our investors to think about this because we think about it all the time. If something's doing really well, there's absolutely potential for momentum and for something to continue. But oftentimes what we see in the market is a mean reversion. So Europe's, again, compared to the other indices, not had a great year, but in the past month has bounced back in a big way. So this is, when you're thinking about allocating capital, if you can go to where, as Wayne Gretzky says, the puck hasn't been yet, we'll go where the puck's going to go, then sometimes there's opportunity to have a little bit of a lift. We actually, throughout the back half of October into November, we're buying European equities, and we've continued to do that here and there in people's portfolios. So this is just an opportunity that the market gives from time to time, and we want to take advantage of it when it does come up. The next slide here, I just want to touch on real quick with respect to the performance of the NASDAQ and in particular the S&P. It's really dominated by tech. And here what you can see is that not all things gold can stay. So in 2000, between Microsoft, GE, Cisco, Intel, and Walmart, that was the largest 5 stocks as a component of the S&P, represented about 18% of the index. And over that time, you can see there's sort of a downward trend up until about 2016, where those large companies lost the percent weighting that they did have. Now, in 16, trends started accelerating, and it was the FANG stocks that had sort of moved upward. Today, we're in and around 20% of the S&P being dominated by Microsoft, Apple, Amazon, Alphabet, and Facebook. So what happens is this kind of hides the actual performance of the market. When you have these 5 names that all, as a matter of fact, sort of benefited from the work from home trend and did well this year, it looks like the overall market's doing well. But if you drill down, it's not the case. There's not as much breadth. At least there wasn't until, sort of the middle of October. We're starting to see more breadth come into the market now, which means there's more performance across sectors. So utilities are okay. Retail's coming back, consumers doing all right, hospitality looks like it's coming back. And all of this is on the backs of, the hope that the vaccine is going to change things. But just a word of advice or a word of caution, when you're investing in these big stocks, the biggest market cap stocks that are out there. There's a million eyeballs on them at all points in time. And sure, you can ride the trend up, but as we've seen time and time again, the largest companies do not always remain, right? If you think back to 2013, the largest company was ExxonMobil. They've lost about 2/3 of their value since 2013 in the face of, let's call it, pressure around fossil fuels as well as weak energy prices. So just keep that in the back of your mind. If you have too much exposure to any of these big names, it's probably something worth trimming back and thinking more about. What we're going to try and do with these videos is also answer questions that we are getting a lot from clients, or specifically that clients are writing in about. So if you do have any questions, please feel free to write in. We'll keep your name anonymous, but oftentimes if you're thinking something, other people are as well. So one of the big things that we've heard a lot this year is, how can the market be up when the economy is struggling so much? And it makes sense just to sort of lay out a fully functioning economy has three different components that all contribute to its strength. So first is the consumers. 2/3 of GDP is consumer spending. So it's you and I out there, going to restaurants, traveling, spending on clothes, all those things that we normally do and might not have been able to do as much during COVID. And part of that is really a function of consumer confidence. So if you and I are confident about our jobs and confident about our future, we're willing to open up our wallets and spend money. If there's not a lot of consumer confidence, then maybe people would be less inclined to spend. And that has significant flow-through effects into the economy. The next pillar is business. So businesses, they create the goods and services that are consumed by the individuals like ourselves, as well as other businesses, both domestically and abroad. So it's an important component of GDP. And then GNP, which is sort of looking at how a country is doing in terms of trade around the world. And then the third pillar is government, right? And government's supposed to be a redistribution mechanism where taking taxes from certain groups or certain companies, people, things like that, and then redistributing them to potential areas that need it more. They're also intended to be a backstop for businesses and consumers in tough times. So when we think about the economy, yes, there's definitely some struggles this year. The consumer is hurting, right? That's sort of apparent if we look around and see the businesses that are shut down and things like that. And this is a chart from the St. Louis Fed. Here we can see unemployment. So through coronavirus, we got up to about 15% unemployment in the US. It's now down to 7.5%, which is half as bad as it was in March, but still about double where we were from an unemployment perspective at the beginning of the year. So there's a long way to go, and consumers are hurting from a actual spending perspective, but then from a consumer confidence perspective, because if your job's at risk, you might not be willing to spend and to stimulate the economy. Next, we can look at corporations. So here we have the orange line, which is most important, and this is corporate profits after tax. Here you can see, if you look back in the financial crisis, there was a big drop. The scale is not that strong, but in 87 as well as 74, there were drops. And obviously here in COVID, there is a big drop in corporate after-tax profits. So that's something to be aware of. And it's really something that's causing concern in the market, because what's happening is corporate profits are dropping, but stock prices go higher. And what that means is valuations are becoming more and more rich, right? You're having price to earnings multiples and price to sales multiples grow, which, as we know, again, with that mean reversion, they cannot grow forever, right? So we just need to be cognizant of what our dollars are being invested in and what the underlying economics of those companies are like. And so, the consumer's hurting, corporations are hurting, and how are we chugging along? How is the market doing what it's doing? Well, really here, this kind of is the one picture that speaks 1,000 words. You can see the S&P index is that red line, and then the blue line, which looks like it tracks it very closely, and in our views, not even a correlation, but actually a causation. It's the central bank balance sheets from around the world. So here we're plotting the dollars that the Fed in the US, the ECB in Europe, and the BOJ in Japan have injected into the markets. And there's a pretty close relationship between how the balance sheet has expanded and how the stock market has gone up. This is something that we have to keep an eye on, though, because balance sheet expansion is not free. It comes at a cost. As governments put more money in, they have to borrow more money. while interest rates are low, they can cover their borrowing costs just like you and I. But at some point, if interest rates do start to back up, then it's going to be very significant costs on the backs of the governments, which is going to flow through and impact the social programs and other spending that governments can do. So just an interesting chart. We'll have to continue to keep our eye on this going forward. And, closer to home here in Canada, the Liberals unveiled a $100 billion stimulus plan. It's going to push 2020's deficit somewhere between 380 and 400 billion. And it puts our federal debt at more than 50% of GDP. So that's a risky area. You can understand the government's position in the sense that they have to stimulate and they have to get the country through this lockdown. We understand that. But we're just saying that it's not without consequence. When you stimulate this much and when you put all this money into the system, eventually you have to pay for it. As David always says, debt doesn't disappear. And this is government debt, which is going to have to get paid off either through higher taxes, through less social support, or some other mechanism that we'll have to see what they come up with next. So another question that we've been getting from the clients across the board is really, what are you expecting in the stock market next month? We've had, sort of a really interesting 11 months. What's the 12th month of the year going to look like? And from our perspective, I think the thing to expect is volatility. And we've seen volatility throughout the year, but in particular, we're going to see less liquidity. So less people are going to be trading as they start to go into the holiday season. Some people are going to take their gains and shut it down for the year. So when you have less supply and less demand in the market, it can mean that prices can move more than they otherwise would. We'll probably see some rebalancing. So what that means is the stocks that have done really well, oftentimes from a risk perspective, investment managers will decrease the weightings of those. So stocks that have gone, have had good years, will see some selling pressure as people try to take some of their gains. The flip side is we might see some tax loss selling. So there, the stocks that have done really bad, we might actually see even more pressure because people are saying, let me take this capital loss and I'll count it against potentially some of my capital gains for the year. One of the other trends that tends to happen in December is what's called a Santa Claus rally. So from our perspective, because we're not trading the portfolio, this is really just window dressing. And with window dressing, what the portfolio manager is doing is they're saying, I didn't hold a stock that's done really well this year, but let me put it into my portfolio so that when I report at the end of December, it looks like I've been smart and I've been holding this company along the way. The other thing I think is that Congress is potentially going to pass some sort of stimulus bill before the end of the month. There seems like some bipartisan conversation right now in the US between the Republicans and the Democrats. But the chances are it's going to be more of a skinny bill, which wouldn't be as much stimulus as the Democrats potentially want. So that could have some impact in the market, given the sort of correlation between government stimulus and what the S&P 500 has done. At the end of the day, what we're going to do is what we've been doing all year. We're going to look for opportunities where there's mispricing and potentially pull the trigger to increase our allocation to stocks that are trading below what we think is the fair value. But at the same time, we still want to hold a bunch of cash because getting into 2021, even if Joe Biden gets in, there's still a lot of work, right? He's not going to be able to flick a switch and change things dramatically. And the same goes for the vaccine. There will be vaccines coming, but it's probably not going to be something that happens in the first quarter of the year. So there is light at the end of the tunnel, but probably still some bumps along the way. And that's why we want to have cash to take advantage of any short-term opportunity. As always, thank you very much for tuning in. We really appreciate you taking the time to do so. And if you have any questions, please reach out to myself, David, or Annie. Take care. Bye-bye.